Hello and welcome to today's Office Hours presentation. This is Paul Hoyt. Our Office Hours presentation is a relaxed informal mentoring program that we do every Monday at noon Pacific time. All these recordings, slides, and exercises are archived in the members area of our website, and all the recordings are currently available on my YouTube channel at youtube.com/user/Paul Hoyt. The reasons we do these office hours presentations is that we know that being a successful small business owner can be a fantastic experience, but we also know that it's tough. You need education, training, tools, and team to be successful, and we want you to get to know us because when you do get to know us, you'll know that first and most importantly, we really do care about you. We want you to succeed in every area of your life, whatever that means to you. We want you to find the greatness, the happiness, the divinity within yourself, and then remember it, embrace it, and live it every single day. Our passion is to increase the survival rate, accelerate the growth rate, and reduce the struggle rate of businesses in America. And our vision is to help millions of CEOs and entrepreneurs accelerate their business growth while enjoying greater harmony and balance in their lives. If you find these office hours presentations to be beneficial, please pass the word along. Everyone who listens to this knows that there are other business owners out there or people who aspire to be a business owner who might gain some value from these office hours presentation. And that's why we do them, because we want to do everything we can to help businesses in America, especially the very small businesses and the starting businesses, get started out on a firm foot with a great foundation. Our office hours agenda is usually an in-depth discussion of a business success principle. Then we offer some closing remarks, special offers, and an invitation for next week's session. And then we go into opening Q&A and coaching. So as you listen to today's broadcast, if you think of a question, if you have a comment, please write it down, put it into the chat log in the window, and we'll call on you if we possibly can, or we'll just answer the question at the end of today's session. And as a reminder, the best question or comment wins. And we do have some people on the phone right now who've won in the past and who have great questions or comments, so we want to hear yours as well. During the week, we invite you to join us in the Awakened CEO communities on both LinkedIn and Facebook, where we publish a business success principle of the day about 4 days a week. And I do an energy of the day posting every morning on Facebook. When I get up, I try to say something insightful or inspirational to other people. I think today was day 1063 in a row. Today's topic is on cash flow secrets, managing the ins and outs of money in your business. As always, we try to relate the subject matter of the day to one or more of the key performance areas of success that I defined in my 2004 book on the foundation factor. And this one is all about financial management. When it comes to managing and running your business, whoever is responsible for financial management, and of course, if you're the CEO of the business, that means the responsibility is eventually yours. But whoever has the day-to-day responsibility for financial management, cash flow is probably the number one job that they have, making sure that you have sufficient cash in the business to operate the business. We also try to relate the subject matter of the day to one or more of the 9 areas in the Awakened CEO system. The 9 nonets, as it were, are the intersection between the growth areas of business growth, professional growth, and personal growth, and the levels of performance with mindset, methods, and momentum. And today we're going to talk about 5 of these 9 different ones. We're going to talk a little bit about mindset and methods when we get to the end of today's presentation. Our agenda for today is that we're going to talk about the importance of cash. We'll talk about the cash flow statement. We'll talk about sources of cash, uses of cash, forecasting cash, tips to increase cash, and sum it all up with the bottom line. First of all, let's talk about the importance of cash. We've all heard that cash is king, but what does that really mean? Well, it means that cash is really the lifeblood of your company. Now, I don't mean to be gruesome here, but if you have a major injury and you lose a tremendous amount of blood, you can die from blood loss because your body needs to have blood circulating throughout the body to keep the organs healthy, to keep blood to your brain, to keep blood to all of the organs in your system. And if you lose too much, you can die strictly from blood loss. And so it is with your business. Just like an individual, if your business doesn't have enough cash, it can die as well. It may be a little less morbid to think about it being the energy flow of your company, about how energy in terms of cash flows into your company, and how energy flows out into your ecosystem when you pay cash out to your employees, to your suppliers, etc. So let's think about it in a little less gruesome terms and think about it as energy flowing into our company via cash and energy flowing out to the world and keeping it circulating in the economy as the energy flow of our business. But one of the most interesting things to know, and we'll talk about it in length today, is that you can run out of cash even though that you are making a paper profit. Now, when it comes to cash flow forecasting and managing cash, we all know that we have financial statements with our company, and there are three major types. There's the profit and loss statement, or the income statement, that most people know about. Another higher level of accounting knowledge and financial management has to deal with the balance sheet, but the even higher level has to do with the cash flow statement itself. Most companies produce a P&L to see how they are doing on paper. Many companies produce a balance sheet that helps them understand how they are building up the asset value of their business and what the business might be worth and who owns what. But unfortunately, not very many people, not very many companies produce regularly a cash flow statement and really study it. Whenever I produce investor-grade financials for my clients, it's always all three of those statements, the income statement, the balance sheet, and the cash flow statement, month by month for a minimum of 36 months, oftentimes 60 months, and in some cases I've actually gone 84 months or 7 years, because it's really the only way to project the true cash requirements of the business. If you're just projecting an income statement, you really have no idea how much it's really going to cost from a cash point of view in order to run your business. And when we do that month-by-month forecasting, that month-by-month projecting of the cash ins and outs of the business, it often results in a change of the growth strategy and the funding strategy, because we recognize where the low-hanging fruit is and we recognize where the sources of cash are. And if we can optimize the sources of cash and minimize the uses of cash, it requires less cash to start the business, and it requires less cash to run the business. And that means that you're going to have to borrow less. It means that you're not going to have to put near as much of your own savings or profits back into the business. It means that you might not have as many investors or sell as much of your business to investors in order to start and grow your business. So it's really, really important. Let's talk about that cash flow statement. As it turns out, there are actually two very popular and very well accepted forms of the cash flow statement. The first form of a cash flow statement starts out with seeing what your net income is, or projecting your net income. And then we talk about adjustments to cash from the operations of a business. We look at adjustments to cash flows from investing activities, and we look at adjustments from cash flows from financing activities, and then we calculate what the net increase or decrease is in cash based upon all of these different areas. We're going to talk a lot more about that here in just a minute, but I do want you to know that there is a second form of cash flow statement, and that second form of cash flow statement starts out with a beginning balance, then we add in the sources of funds, we subtract out the uses of funds, and that gives us our ending balance in cash. When we get into the latter part of today's presentation, we're going to show some examples of that. But here it is in the first one of the examples is that we start out with $5,000 a month, $5,000 in cash. We track or project our sources of cash. We track or project our uses of cash, and we end up with the ending balance. But we're going to defer that for just a little bit, and I want to go back to cash flow statement 1. The reason why we're going to talk about cash flow statement 1 is because it's easier to talk about sources and uses of cash if we do it by areas within the business. So we're going to look at sources and uses of cash in operations, sources of uses of cash in investment activities, and sources and uses of cash in financing activities, and I think it's all going to become pretty clear to you. So let's start with the net income. The net income contributes to the cash available in your business whenever you run a profit, and you consume cash available to the business whenever you have a loss. And that makes sense, right? If I made money last month, if I got $10,000 in revenue, but I only wrote checks for $8,000 of it, then I should have $2,000 more left over at the end of the month than I had before. Likewise, if I only got $5,000 of revenue and I had $8,000 of expenses, I'm going to have $3,000 less in cash at the end of the month than I had at the start of the month, usually. And the usually comes in because there's a lot of adjustments to that simple cash flow scenario that I just talked about based upon operations, investment activities, and finance activities. Let's talk about those. So we make adjustments to our cash forecast and our cash balances based upon other aspects of operations. And here's some examples of that. First of all, increases in accounts receivable reduce the amount of cash that you have on hand. And likewise, decreases in accounts receivable provide cash. So if we sell something on credit to somebody, if we sell something for $10,000 and we book the income this month, but we tell them that, hey, you don't have to pay us all at once, just pay a little bit down and then say $2,000 a month for the next 4 months after that, we have decreased the cash that's available to us by giving somebody else credit and by building up our accounts receivable. So as we increase our accounts receivable, we have decreased the cash that's available to us. Likewise, when that customer pays their $2,000 the next month and pays their $2,000 the month after that, thereby decreasing the accounts receivable, it increases the cash that we have to use. So I hope that's pretty simple. As we increase our accounts receivable and we give our customers credit and we say that you don't have to pay us right away, we are absolutely decreasing the cash that comes in the door. And as they pay us, which reduces the accounts receivable, we have more cash that comes into the door. Another way that we have adjustments to our net income from operations that impacts the cash flow is through depreciation and amortization. If we have purchased an asset at the company and we are depreciating that over time or amortizing that capital asset over time, then when we produce the net income of the company, we take out that depreciation expense and that amortization expense. But they didn't really consume cash. So when we make adjustments to our cash usage based upon operations, we add back in any amount of depreciation or amortization expense that we have booked in the income statement. But wait, there's more. Increases in inventory consume cash, and decreases in inventory provide cash. So if we're going to need to order that next 10,000 units from China somewhere, and we have to pay them a down payment, that down payment, which increases, by the way, on the balance sheet, the inventory that we have, decreases our cash because we've paid for inventory in advance of consuming that inventory. Likewise, as we consume that inventory and we book it on our income statement as cost of goods sold, then it actually provides cash to us because we're really not consuming the cash in the time that we have used the inventory. We had consumed the cash months earlier when we purchased the inventory in the first place. Increases in accounts payable provide cash, and decreases in accounts payable consume cash. What this means is that as we don't pay our suppliers, or in other words, as we delay payments, we increase the cash that we have on hand. And I think that makes perfect sense. If somebody sends me an invoice for $2,000 and I pay them today, the cash goes out of my bank account today. If I pay them in 2 weeks or 4 weeks, the cash doesn't go out of my bank account for 2 to 4 weeks. So we've increased our accounts payable, and increasing our accounts payable means that we have either maintained a cash balance or increased the cash balance that we have on hand. Likewise, when we pay that debt, when we pay that invoice that came in, it decreases the cash on hand. Those are the types of adjustments to our net income and the cash that the net income provides to us based upon what is considered to be normal operating activities. Changes in accounts receivable, changes in accounts payable, changes in our inventory levels, and the depreciation and the amortization that we recorded on our income statement. There are other ways and other things that we can do with our business that also have a dramatic impact on the cash balance that we have. One is investing activities. Anytime that we take the cash that's available in our business and we buy fixed assets with that, it consumes the cash. When we buy a desk, when we buy some sort of an office setup of some kind, when we buy fixtures, lighting and tables and chairs and other sorts of stuff, office equipment of some kind, and we capitalize that, it consumes cash. When we purchase trucks and automobiles, it consumes cash. When we purchase buildings and land, it consumes cash. When we invest in the assets of our business so that we can run a business more profitably down the road, or perhaps even just to keep the doors open, it consumes cash. Likewise, selling those assets increases our cash. So if we find that we sell an automobile because we're not just using it, or we sell some furniture because we're not using that furniture anymore, then that can increase the cash that we have on hand. It decreases the assets on the balance sheet from the actual fixed assets and increases the assets on the balance sheet from the cash that we had that we traded out for that asset that was on the balance sheet. Another way in which we can invest in our business is through the investment in what we call capitalized product development expenses. So if we are hiring somebody, for example, to build, to invest in patented technology, we've got a large R&D effort. We can't, if that has significant long-term value to the company, tax laws say that we can't write that off right away because it really should be booked as an asset to the company. And so we may find that we're not able to write off that expense in the month that we actually spent the cash for that expense, but rather we have to capitalize that asset and consider it to be an investment of the business and an asset of the business. And of course, that consumes cash just like it would consume cash if I booked it as an expense. I think that's a little bit technical, but hopefully you got the gist of that. The gist of this really is that we can use the cash available for the business to build a stronger foundation of the business and prepare us to make more profits later on in the business, and that can consume the cash available to operate the business on a daily basis. Likewise, we can consume or increase cash based upon financing activities. Financing activities like interest payable. If we owe somebody interest on a loan but we don't pay them the interest that we owed them today, we may have booked the interest expense this month, but if we don't actually write a check for that, if it goes into interest payable, then it increases the cash that we had available to us further than what the net income would produce or would suggest that we had. Likewise, increases in notes payable. If we borrow money from somebody else, that provides cash. And as we pay that money off, it consumes cash. And increases in investments into the company, whether from our own bank accounts or from an outside investor, increases the cash available. And as we pay those people back, or as we buy back equity that we've previously sold to other people, then that will decrease cash. So decreases in those investments, those outside investments, consume cash. Now, that's how we talk about how we are going to project cash most of the time. I really like cash flow statement number 1, where we start out with net income, and then we talk about adjustments to the cash that the profit and loss or the income statement would seem to indicate that we have based upon our regular operational activities, based upon our investments in fixed assets activities, and based upon our financing activities, either borrowing money, paying money back, or getting money from investors, or putting more money into the business ourselves, that all yield a monthly net increase or decrease in cash. Hopefully that was reasonably clear to you. But as I'm going to make it even more clear, because we're going to talk about specific examples from the second form of the cash flow statement. And as you remember, with this form of the cash flow statement, it's simpler. Instead of going area by area of the business, we just talk about sources of cash and uses of cash. So let's talk about that. Sources of cash. There are lots of ways to get cash into your business. My favorite by far is by selling your products and services for cash and decreasing accounts receivable, which means that you are collecting some money that people owe you. Another way to increase the cash that you have in your business is to increase our accounts payable, which means deferring payments to your suppliers. You can also increase the cash available in your business by selling assets such as inventory or vehicles, or even selling your receivables. That's right. You can sell your receivables. If somebody who has a very high credit rating owes you $100,000, you can go to somebody right now today who will give you $90,000 or $80,000 in cash today for the right to collect on that $100,000 worth of receivables. So your receivables, much like your inventory, much like your other fixed assets, are an asset to the company, and you can monetize that. You can get the cash for that right away today, if you can find somebody who will allow you to, who will provide cash based upon the value of that future accounts receivable. Banks, by the way, will do that. Banks will loan you money based upon the inventory that you have. They will loan you money based upon the receivables that you have, and other people will simply purchase the receivables that you have. You can also, as we mentioned earlier, receive investments into the business, either from yourself or from somebody else. And the last one is borrowing, either borrowing money in an installment purchase contract of some kind or installment repayment contract of some kind, or borrowing money on a line of credit, which doesn't typically have a firm payment, a fixed payment each month associated with that. So those are the sources of cash. When you think about, I need more cash in my business, think about selling your products and services. Think about collecting the money that people owe to you. Think about deferring payments to your suppliers, and then think about other ways in which you can get cash into your business. Because there are plenty of ways to use cash in your business. Here are some of them. Whenever we deliver a product or a service, there is typically a direct cost associated with that. Whenever we sell a widget off of our shelves, we have to replace that widget on our shelves, or we have to purchase that in the first place, and it costs us money to do that. There's almost always a direct cost associated with delivering a product or service. The only exception to that is if we're selling an information product or a completely digitalized asset that has no cost of goods sold associated with it whatsoever. And of course, that's why so many people like to sell digital products and like to sell informational products and like to get people to download their digital assets for money, because there's no cost of goods sold. Extremely high margins on information products and on other digital assets. When we have the direct cost of goods sold, we can pay for products or services that we can sell, but there are other forms of it too, like commissions and royalties and merchant account fees. All of those will go into consuming cash in a way that we need to project and need to understand. Merchant account fees will take up to 3% of the revenue that we enjoy through credit card fees. Royalties, if we've licensed the use of somebody else's intellectual property, can take 5 to 10% of our revenue stream. Commissions, we may owe our internal sales department or outside affiliates anywhere from 5 to 10 to even 50% of the cash received. but we just don't have to make those payments until we've actually sold something. And that's why they're called direct costs or costs of goods sold. Uses of cash, as we talked several different times, increases in accounts receivable. Giving customer terms and allowing people to pay over time will decrease the amount of cash that you would otherwise have if you collected the money on the day of the sale. But wait, of course, there's more. Current operating expenses all consume cash. Payroll, insurance payment, health insurance, marketing expenses, automobile expenses, travel expenses. There are probably 30 or 40 different categories of operating expenses that I go through each time when I do a financial statement for one of my clients, or rather financial projections for my clients. You can consume cash by prepaying expenses. You can consume cash by making down payments and deposits on things that haven't been delivered yet. You can consume cash by paying down your accounts payable, by paying off your suppliers. You can consume cash by purchasing assets, as we have talked about before, purchasing inventory, investing in R&D activities, buying furniture and fixtures, buying cars and automobiles, buying buildings and land, etc. You can consume cash or use your cash by paying off long-term debt, by buying back equity. If somebody says, you know, I bought these 10,000 shares from you a few years ago, but I need the cash, you know, you can purchase that back, and oftentimes large companies especially will have equity buyback programs in place. But by far, my most favorite way of using cash is distributing profits. Distributing profits to yourself, distributing profits to your investors. In other words, using the excess money that your business has generated and taking that back into your own personal bank accounts and distributing profits in dividends to your investors too. When it comes to forecasting cash sources, I like to start out by forecasting cash sales by customer, by territory, by product line, however you choose to forecast it. And there are a lot of different ways to forecast cash sales. Then I like to forecast collections on accounts receivable. And oh, by the way, this is one of the reasons why we have an aged accounts receivable, is because as something moves into 60 days past due, or 90 days past due, or 120 days past due, you're far less likely to actually collect on that debt, especially if it rolls past 90 days. And you may have to actually write off that debt so that you are fairly, really expressing the true financial condition of the business to your investors and prospective investors and to banks, etc. So it is important for you to keep up on those collection activities, and it is important for you to write off that debt when you believe that it has become uncollectible. Then I like to forecast cash sources by extending payment terms from suppliers, by any sort of activity that we have planned for selling off assets of the business, any activity that we have planned for borrowing money into the business, and then any activity that we have planned for investors to contribute to the business. That's how we forecast the cash sources. We forecast our sales, forecast our collections, forecast on our ability to gain cash into the business by deferring our payments to suppliers, then selling assets and borrowing in investors. Those last three being things that don't happen very often, typically. Then we forecast our cash usage, the cost of goods sold and direct costs, our other operating expenses, which may be recurring operating expenses like rent, periodic operating expenses like quarterly payments to sales taxes and for payroll taxes, and also forecasting unplanned expenses. And that sounds a little bit difficult, but you do want to make sure that you have some cash reserves that allow you to forecast. You know, historically we have $5,000 or $10,000 or $500 or $1,000 worth of every month of unplanned expenses. If you track those unplanned expenses, you can forecast those unplanned expenses. We also want to forecast monies that we are going to spend or plan to spend on product development, monies that we plan to spend on debt service as well. So let's take a look at a few examples. Going back to the cash flow statement number 2, let's take this month by month, and I'll show you in this example how cash is increased and decreased based upon the fairly normal activities of a business. In this particular scenario, this company has $5,000 of cash at the beginning of the month 1. If they received no other cash and they made no other payments, they would have $5,000 in cash at the end of month 1 and at the beginning and at the end of month 2 and month 3. But of course, that never happens in business. In business, we receive cash and we expend cash. So in this particular example, we're going to say that they had $5,000 in cash sales. They got $2,500 in collections. In other words, somebody who owed them money gave them $2,500 in payment of a previous debt. They decreased their accounts receivable by $2,500, which increased the cash available, and their sources of cash in month 1 were $7,500. Pretty good month. Looks pretty darn good, doesn't it? But with this business, they had some costs. Their direct costs, in other words, the cost of selling this $5,000 worth of products and services was itself $4,000. In other words, they sold very low margin products or very low margin services. They had standard office expenses of $2,000. They invested in product development of $4,000. They paid off previous debts of $500. So they consumed $10,500 in cash. And as a result of that, they only had $2,000 left at the end of the month. So they had $5,000 to begin at the beginning of the month. They received $7,500 worth of cash. They paid out $10,500 worth of cash, and they had $2,000 in cash at the end of the first month. When month 2 came along, it looked like this. They sold $6,000 in products and services. They collected another $2,500 on debt that somebody owed them. They borrowed $5,000 from a bank, giving them $13,500 in cash, the sources of funds coming into the business. They had direct cost of, on that $6,000 worth of sales, of $3,000. In other words, they sold products and services that had much higher margins than the ones that they sold in the first month. Their office expenses were $2,000. They paid off the debt at $500, and they used $5,500. So at the end of the month, they had $10,000. In other words, they received $8,000 more in cash into the business than they expended in that business, and so they had $8,000 more at the end of the month than they had at the beginning of the month. Now, if they didn't receive any money at all in month 3, if they didn't sell anything, if they didn't collect on any debts, if they didn't borrow any existing money, if they didn't get any money from investors, they still project that they're going to have $4,000 worth of cash on hand at the end of the 3rd month, because they know they're going to have $2,000 worth of office expenses. They know that they're going to spend $3,000 on product development. They promise the people who loaned the money that they're going to pay them back $1,000, which is more than the $500, which, by the way, makes sense because they borrowed another $5,000 in month 2. So they're going to have to accelerate the rate at which they pay back that debt. They would still have $4,000 left over, but thankfully in this example, they had $5,000 worth of sales and only $2,500 worth of direct cost, which means that they were able to contribute another $2,500 in cash to the bottom line and had $6,500 in cash at the end of month 3. That's the scenario. That's the example of the cash flow statement itself. But unfortunately, with business, we all have nasty surprises. And I know that, by the way, this is the #1 challenge in business, is dealing with the nasty surprises that consume cash within our business. Here's some examples of some of those nasty surprises that I hope that you haven't seen any of these, but my bet is if you've been in business for more than about 30 days, you've had one or more of these. Here's some of them. Deals that fall through. We expected to close a deal. We expected to get a down payment. We expected to sell a product or service, but it didn't happen. maybe even didn't happen the way that they promised that it was going to happen. Or checks that bounce. Worse yet, the deal came in, and they wrote us a check, but the check bounced, or the credit card number that they gave us, couldn't be processed because of insufficient funds. I hate that even worse than a deal which doesn't come through. Customers that don't pay. Lord knows we don't like those at all. Customers that don't pay in any way, especially those where we've extended terms to them. In our previous example, we sold somebody $10,000 worth of products or services. They said they were going to pay $2,500 down and $2,500 a month for the next 3 months or so, but they failed to pay. So we have bad debt that has to be written off. That's a nasty, nasty surprise with business. Employees leaving, by the way, almost always consume cash in some way. They consume cash because we have to work with a recruiter to find a replacement. We have to pay overtime to other employees, which costs more than paying regular time to the employee that just left. We have to hire an outside service, a contractor of some kind, to do the job that the employee was doing, which will almost always cost more than the wages that we were paying to the employee. So when an employee leaves our business, unless we had planned to cut that expense in the first place and really believe that we can cut that expense without incurring additional outside expense, then when an employee leaves, it's going to cost us money. Suppliers might increase their prices. Equipment might fail. We might have to replace a computer system or replace a printer, and something needs to be repaired or something needs to be replaced. And one of the most unpleasant nasty surprises of all is tax liabilities. We get a notice from the state, or we get a notice from the IRS that we just looked at our records and you owe us more money than you thought that you owed us. Darn it, I hate it when that happens. But wait, there's more. There's other kinds of nasty surprises that we have. Suppliers who don't deliver. We paid them, but they didn't deliver. The boat sunk at sea. I've actually had clients that had a shipment coming in from China, and the boat sunk at sea, and the manufacturer declared bankruptcy, and they were out all of the money that they had paid for their inventory. Unexpected travel expenses. We got a client that's upset, and we have to jump on a plane and go somewhere. Impulse purchases. You have to control those impulse purchases. Those deals that come through that you think is just too good of a deal to pass up, so you write the check for it right now without even thinking it through. Marketing investments that don't work. We sent out a direct mail campaign. We sent out an email blast. We put out door hangers. We paid for an advertisement in the newspaper. We did all kinds of different things trying to generate leads for our business, went to a trade show, went to a conference, but it didn't work out. R&D setbacks. We thought that something was going to cost us $10,000 to develop, but it ends up costing us $30,000 or $40,000 to develop. Economic and competitive pressures. Say that the economy really goes south and causes the flow of customers to drop to a mere trickle into our business. That can be a very nasty surprise. And one of my least favorites, again, is legislation. Our government comes together, either state government or federal government, and passes legislation which increases our tax, prevents us from using a previous tax loophole of some kind, which decreases the amount of money that we're going to have because of that nasty surprises. So we all have those nasty surprises, no matter who we are and where we are in business. And here's some tips or some ways that we can deal with them. First of all, always require down payments from customers. No matter what you do, always require at least a down payment, if not full payment in advance from your customers, so that you at least cover the cost of doing business. So if somebody's going to buy something for $10,000 and it's going to cost you $5,000 to deliver that service, by all means, make sure that you collect at least $5,000 down, so that you aren't depleting your own cash as you deliver that product or service to a customer. Accepting credit card payments. Yes, it does cost you 3%, but it does mean you get the cash within 2 to 3 days, and that's incredibly important. You can offer discounts for advanced purchase or for volume purchase. A typical one might be that you want somebody wants to sign up for a year-long coaching program. They can pay either $1,000 a month, or they can pay $10,000 up front and get 2 months worth of services for free. So when you offer discounts for advanced purchases, you can accelerate the cash flow in your business. You can make pre-collection calls. A pre-collection call means that you're picking up the phone and you're talking to somebody and saying, hey, that invoice that I sent you a couple of weeks ago is going to come due in next week. Is there anything that prevents you from paying that invoice? Could you check and make sure that it's scheduled for payment for me? That's called a pre-collection call. They don't really owe you the money right now. You're just wanting to make sure that they're going to pay the money to you on time as you expect it. That is a great way of increasing the cash in your business. Another great way is making those collection calls. I tell you, most people don't like to make collection calls. It's a real mindset issue. They feel like in some way that, you know, it's just terrifying to them. They have a lot of hesitation or resistance in making those collection calls and reminding people of their commitment to make those payments. But you need to be able to do that. As the CEO of your business, you have to be able to make those collection calls, and you have to be able to manage that collection process. It's just one of the requirements of doing business. One other tip that you can have is to enter into leases instead of purchasing assets. Leases for equipment in your plant, leases for office equipment, leases for trucks and automobiles. There's all kinds of opportunities to lease what would normally be a fixed asset and thereby increase the cash that's available to you for regular operating expenses. Those are just some of the tips that we would offer when it comes to increasing the cash flow at your business. Here's the bottom line. The bottom line is you really have to be good at managing cash, or you're going to be in big trouble with your business. No questions about it. You are going to have nasty surprises. I have had nasty surprises, but occasionally, hopefully, you'll have a windfall on the other side of that, a really good surprise. Somebody that says, you know, Paul, I'd really like to pay you today. No discount necessary, but I'd like to pay you the full amount today. I have had customers do that for me, and I just always feel blessed when they pay me in advance because they really feel like doing so. It's wonderful when that happens. So you have to make sure on the bottom line that you have plenty of cash and credit available to weather the ups and downs of business. That is the bottom line. Here at the Awaken CEO System, we try to relate the subject matter of the day to one or more of the tenets of the Awaken CEO System. So I want to talk to you both about mindset and methods. From a mindset point of view, you really need to understand the importance of managing cash. And like I say, it doesn't take too many months in business before you realize that cash really is the lifeblood of your business. It doesn't take very many times until you come across, hey, gosh, I got to meet my payroll and I don't have the cash on hand before you realize the importance of that. But I want you to embrace the opportunity that you have to better manage the cash and believe in yourself. Believe that you can learn to manage cash better over time, and you can be much smarter when it comes to managing cash in your business, and get over any resistance that you might have to dealing with the cash flow challenges of your business. You just got to get over it. I know it does scare us when we look at the bank account and we look at the sources of funds and we look at the potential uses of funds, but that fear really does not help us unless it really spurs us into action. And then when you get into action, you got to let go of the fear and you got to get over it and you got to deal with it with a warrior's mindset that I am going to deal with this successfully and I'm going to get better at it over time. And as we get better at it over time, we employ methods. We produce and study a cash flow statement every single month. We talk to our CFO and other financial advisors about how to do better and brainstorm their ideas for increasing the cash at our business and implement some of those tips that we provided earlier in the presentation so that you can build up a cash reserve so that you won't have near the cash flow challenges that you might have otherwise. That's been our agenda today. We talked about the importance of cash. We talked about the cash flow statement, sources of cash, uses of cash, forecasting cash, tips to increasing cash, nasty surprises, and summed it all up with the bottom line. Here's your homework. Download the cash flow template that we're going to offer as an Excel spreadsheet in the members area of our tribal portal. and sample financial projections as well. Create your own cash forecast for the next 90 days and see how accurate you are by checking to see what your cash balance really is based upon, and compare that to the forecast. By the way, plus or minus 20% is very, very common. If you can come within 20%, that's a pretty good thing. Oops, there we go. And somebody noted that I was muted, and it was for the last couple of minutes. I apologize for that. Thank you very much. So you didn't get to hear those last few sections, but I'm not going to repeat them because we're just about out of time, and hopefully you got to see them on the presentation. Thank you very much for letting me know that I was still muted. I thought that I was going to sneeze, so I put myself on mute for a second, but that it didn't actually do that. So thank you. Let's see if we have any other ones. I think most of the comments were on the fact that I had been muted there for 2 minutes. So thank you for sharing that with me. We did, however, have some questions that came in via email before we started today. So I'm going to handle a couple of those real quickly here. Number one was on, can you talk again about how you can be unprofitable on paper but yet really be losing cash? And so let me see if I can give another way of sharing that with you. If every transaction that you had in your business was a pure cash transaction, if every time that you sold something, it was really cash to you at the time of sale, and if when that sale happened that you never had to incur any cost of goods sold or any other sort of investment until you actually received the cash from the customer. And by the way, there are businesses that are like that. They don't have to pay for the goods and services that they sell until they actually receive the cash from the sale of the business. And if you never had to pay for anything in advance of actually consuming that product or service, there would be no difference in between your income statement on a cash flow basis and your income statement on an accrual basis. But for most people, we have to buy inventory ahead. We have to prepay for some of our expenses. we have to incur some expenses in our business ahead of enjoying the revenue that those investments allow us to enjoy. And that's the big difference. A huge difference in between the cash flow in the business the cash flow when we're running a pure cash business and when we're running a business that we accrue some income and accrue some expenses ahead of actually the transaction of the business. Hopefully that would help a little bit, but that's the big difference. By the way, when you produce your tax statements at the end of the year, you typically do that on a tax basis instead of an accrual basis, so that your tax liabilities are calculated based upon the actual ins and outs of the flow of money into your business. So there typically is no difference in between your tax statement, your tax forms, your tax returns rather, and the actual cash position at your business. Next question is, should I lease a car or buy a car? And that really depends, by the way, on your cash that you have in your business and how good of a deal you can get on purchasing a car versus leasing a car. For example, if you're somebody in your family says, hey, I need to sell my car right away. It's worth $10,000, but I'll give it to you for $5,000 if you can pay me the cash today. If you get a really good deal on it, it may really be in your interest long term to buy that car right away. If you have a lot of cash left over in your business and you don't want to pay taxes on that cash, or you don't want to distribute the profits on that cash, you may consider prepaying some expenses, which means that we'll buy a car and depreciate it over time, as opposed to paying for a lease on a car. So those are just some of the considerations that I would encourage you to consider. Number one is, do we have the extra cash that allows us to make an investment in our business by purchasing an asset instead of leasing an asset? And number two, how good of a deal can we really get? If this is really a good deal, then we may actually want to borrow money and buy that asset instead of using the cash for the business, because it is such a good deal that we know that it's going to pay off either in the short term or in the long term. Hopefully that helps out a little bit. Next question. How often should I do a cash forecast? How often should I do a cash forecast really depends on the cash that you have in your business. For some companies, they don't need to do a cash forecast, more than once every few months or so when they are considering a major investment. So for example, they're considering spending $100,000 on a new internet marketing campaign that's going to require them to spend $30,000 upfront and then $30,000 a month for the next 3 months. Might be a really good idea to do a cash forecast over the next 6 months and see what the impact of that really major expenditure is going to have on their cash balances. Do I have enough to make payroll? Do I have other obligations? Have I got other ways in which I can invest in the business that I already planned to do, but so that they can make sure that that's a good investment? Some businesses who don't have a lot of cash, or even those that do have a tremendous amount of cash, forecast the cash balance on a daily basis. That's right, on a daily basis. And here's an example of a business who might want to forecast daily cash balances. A company that has $1 billion in cash assets will want to forecast the ins and the outs and make sure they understand exactly what the cash balance is in their business and what they're going to need cash for tomorrow before making decisions as to what to do with all of their excess cash today. Because in many businesses, we will sweep the cash out of investment accounts into other sort of out of operating accounts rather, into investment accounts on a daily basis, because we can get 1 or 2 or 5% interest on the cash that we're investing in our business. and we have to make sure we have enough cash in the bank account to cover the debts, the cash expenses that'll be here tomorrow or the next day, before we move that cash into an account which can be swept and then therefore will pay us interest on that. So companies that have very little cash and companies that have a tremendous amount of cash will forecast the cash needed on a daily basis to make sure they're managing their cash correctly. The rest of us typically don't forecast cash on a daily basis. We do it on a weekly or a monthly or even longer than that. Hopefully that was helpful to you. Next question. Why would I ever want to prepay expenses? Excellent question. Here's a good answer to that. At the end of the year, if you find yourself having a lot of profits and you don't want to pay taxes on those profits this year, you want to defer the taxes to next year, that you've got enough money to draw out of the business to take care of yourself, then we might consider prepaying expenses. We might, buy something in advance of when we were buying it. Instead of buying $100,000 worth of inventory, we might buy $200,000 worth of inventory and prepay expenses in those ways. We might call up a landlord and say, hey, can we prepay 90 days worth of rent because we've got the excess cash and we'd like to do that. And oh, by the way, can you give us a slight discount for that? So if you have the excess cash in your business, it can be a good way to use that excess cash by prepaying expenses, especially if you can get a discount on those expenses whenever you prepay those expenses. Hopefully that was a good answer for you there. And I'm going to call this the last question because we do have 1 o'clock. Do I need a cash reserve? Can't I just use a line of credit? And I would say yes, you can, depending on your bank arrangements. So if you have a line of credit with your bank, a lot of companies will move money in and out of their line of credit on a daily basis or on a weekly basis as they do their cash forecasts and as they need more money coming out of the business. It is a bit of a hassle, and it does take a little bit of time. So unless you've got somebody dedicated to that function of spending that 15 minutes a day, 30 minutes a day, of projecting your cash flow requirements and determining how much you can pay down your line of credit today versus how much you need to draw down your line of credit today, it can be a little bit of a pain in the keister. So you may only want to do that on a weekly basis or a monthly basis, but you can use a line of credit instead of a cash reserve. Lines of credit, as I mentioned earlier, can be based upon the amount of inventory that you have, can be based upon the amount of accounts receivable that you have. Typically, banks may loan up to 50%, in some cases even 80% of the value of your accounts receivable and your inventory, and loan that to you and allow you to use that for your daily operations of a business. Otherwise, they can also establish a line of credit that's based upon your personal guarantees. And typically, by the way, that's the way that very young businesses have to do it. Based upon your personal line of credit, you will find that a bank will give you a business line of credit that is personally guaranteed by you. And that can be a wonderful way of borrowing and using money and paying back the money. I prefer, frankly, doing both of those. Having a cash reserve so that you don't have all of those transactions with the ins and outs of your line of credit. I don't think you want to be having $30 and $50 and $100 transactions out of your line of credit. I like to have $1,000 or $2,000 or $5,000 transactions in and out of the line of credit, preferring to hold the rest of that cash in just a regular cash the checking account of the business, so you don't have to hassle with that ins and out of your line of credit. So I think both. I think have a cash reserve and have a credit reserve. So the cash reserve is knowing that I've got cash in my bank account right now that I can pay bills with, that if I need to put something on a credit card or a debit card, I don't have to worry about when I'm at the store that only accepts a debit card, whether or not I've got enough money in my bank account to do that because I've got a cash reserve on hand. But I can periodically go and use my cash reserves in the business in order to replenish, or use my credit reserve in order to replenish my cash reserves in the business. I hope those answers were good for you. And here's another one that's coming in to me right now that I'm going to try to take. When working with Amazon, are there hidden issues, including terms? You know, that I really don't know, and I'm going to invite us to go off of the guy who writes this question is a long-term client and really good friend of mine, Michael Charters. Michael, I took you off of mute. If you're able to ask that question live, I would love it. Are you there? Can you talk to us?
Yes, good afternoon, Paul.
Good afternoon.
Good. I'm working with a professional individual on the East Coast that's helping a friend take a product to market, and they're going to enter into a contract with Amazon online. And because it's so big, I'm just questioning, their payment terms, how quickly they're able to access that money as they sell products there, because as they get into volume, it's going to create a cash flow problem. And sometimes over time you begin to realize there's some subtleties. For example, UPS in the earlier days, if you sent things out COD, they would collect the money and then potentially it would take 30 days for them to pay you back, which was an unanticipated delay in cash flow. So I was curious if Amazon had any, or if you've heard any issues in their transactions.
No, I have not. I'm going to put you back on mute for a second. The only experience I have working with Amazon is buying things from Amazon, and then I've got a few books for sale on Amazon too, and every month or so I get a small check in from them based upon the books that I have sold. So in the particular case of them selling a book that they print, that they deliver, I get monthly checks from them. But I don't know, I honestly don't know, whether or not when they sell a product on Amazon, whether or not they fulfill it out of their logistics center or whether or not you fulfill it, how quickly you get paid on that. I don't know if it's like a credit card and you get paid in 2 or 3 days once they get paid, or whether there's some deferring of that of 10 days or 30 days. So I wish I knew that, and I would encourage you that as you find the answer to that, let me know. I do have some clients that sell products on Amazon, and I may be able to reach out to them later on if you can't find the answer for yourself in some way. Great example of a question that I didn't know the answer to. As I was yesterday, even though I've been working on myself for 50 years, I'm still working on myself. And even though I've been in business for 50 years, I'm still learning every single day about things in business to help me and help my other clients do better in their businesses as well. And right now I've got 1:06, so I'm going to bring our office hours presentation to a close for today. Michael, thanks so much for that question. You win the prize. Please get a hold of me in the next day or so. I think I owe you a couple of hours now, because you've been so good about coming on to the office hours presentations and asking great questions and offering great comments. And I'd love to support you with this venture that you're in, whatever that may be. So thank you very much. I really appreciate you attending today, those of you who attended live or those of you who are listening to the recording. We love to do these office hours presentations, do everything we can to accelerate your progress, reduce your struggle in business, because I really do care about each and every one of you. And until we meet again next Monday or before, this is Paul Hoyt wishing you a most marvelous and prosperous day. Bye-bye.